This is just that fine line that Beijing policymakers continue to have to walk.
Well, Heidi, indeed, what we're seeing, wherever you look, you're seeing officials now, regulators stepping in to try and curb or affect price changes. You don't have to look very far indeed. You can go online, you can see the fact that they're censoring any searches for crypto exchanges. We know, of course, that they've considered capping the price of thermal coal. The most recent development was the call for state-owned enterprises to reduce their exposure to commodities. The list goes on. Banks, domestic banks, told to hold more foreign currencies. Brokers banned from publishing any reports with bullish targets for equity indexes. What it all points to is a deep, visceral concern here in China right now about financial risk. And a lot of that is tied to what's happening outside and beyond China's borders, where officials have said that the easy policy of many central banks has led to an inflow into Chinese assets and created some of these bubble risks. And this is where the concern lies. The problem is, of course, that it undermines, as you say, that push for Xi Jinping and his officials here to liberalize the markets. And it also, of course, increases the chances of moral hazard. It does nothing to address moral hazard.
Right. Of course, I can't help but think, Tom, there are some regulators around the world who envy China's ability to do this to their markets. But more specifically with commodity prices, this is a very important part of the Chinese economy. What are some of the specific steps being taken there?
So I touched on this. So this call from the regulators here yesterday, quite an eye-opener for the state-owned enterprises here to reduce their exposure to commodities. But arguably more surprising was the announcement that China, after many years of not doing so, would be releasing some of its secretive metals reserves onto the markets to pressure prices lower. They have not done that for years. And what that underscores is their concern that the rally that we saw in terms of commodity prices, particularly industrial metals, that we saw acutely in May, will eventually feed into higher consumer prices. They don't want to see that passed on. Yigang, the PBOC governor, as you know, Kathleen, has said that he sees inflation, CPI, at below 2%. That's what they want to see for 2021. But they're clearly still concerned about the run-up in commodity prices, given the action that we saw yesterday.
We had pretty key eco data out yesterday as well. Does it show a theme of stability, I guess, in the recovery?
Well, to some extent, the data that we saw yesterday, retail sales, industrial production, investment, all came in below the numbers that we saw in April. But if you compound it over 2 years, and that strips out the distortions that we saw last year, then you actually saw industrial production and retail sales improve and increase. Industrial production, the support, the demand for Chinese exports, that continues. Retail sales, though, still not back to pre-pandemic levels. And that is important. A big focus on what's happening with China's consumer, the K-shaped recovery here. So high-end and expensive retail goods, they're still being snapped up by China's consumer, but at a lower level, that is still an area that's missing out. In terms of the implications for the PBOC, the suggestion from the likes of Standard Chartered and others is that the central bank here will continue to tread a very fine line. They don't want to undermine what's looking like a relatively stable recovery, but with some concerns still around the consumer.